Banks don't pay $100 for a $100 bill. They pay the cost of printing, usually around 3 to 10 cents per note. Welcome back to the Lynette Zang channel. I'm Emerald Fox, and today we're talking about something most people never question. When you walk into a bank or hit up an ATM, where did that cash actually come from? Do banks print it, buy it, or borrow it? The answer opens the door to how money really flows behind the scenes. And once you understand that, it becomes a lot easier to see where the risks are and what to do to protect yourself. So let's start with the basics. The Federal Reserve, aka the Fed, is the central bank of the United States. It controls the U.S. money supply, helps stabilize the economy, and yes, it's the one responsible for printing our physical dollars. But here's what most people don't realize. Just because the Fed prints the cash doesn't mean banks get it for free. In fact, there's a whole process behind how banks actually get their hands on that money. And spoiler alert, they don't pay full price for it either. Every commercial bank like Chase, Wells Fargo, or your local credit union has an account at the Federal Reserve. Think of it like the bank's digital wallet at the Fed. It's called a reserve account. These accounts aren't like an account you or I would have. Can't swipe a debit card or Venmo from it. These are behind-the-scenes accounts used to move money between banks, settle large transactions, and exchange for physical cash. So when a bank needs cash to fill ATMs, stock branches, or prep for payday, it contacts the Fed and says, "Hey, I'd like to withdraw some paper money." And well, the Fed says, "Cool," and deducts that amount from the bank's reserve account. Then it sends over the cash via armored trucks. So yes, the bank pays for that cash, but it's paying with digital reserves, not physical dollars or customer money. So what are these reserves they're using? They're not cash, they're not customer deposits, they're digital dollars created by the Fed that only exists inside the central banking system. Banks use reserves to settle balances with each other, meet Federal Reserve requirements, and convert to physical cash when they need to. It's like a private financial network between the Fed and the banks, invisible to the public, but absolutely critical to keep the system running. When you go to an ATM and withdraw $200, you're seeing the end of a process that started with a reserve transaction at the Federal Reserve. Now let's answer the big one. Do banks pay full price for the cash they get? Well, they don't pay $100 for a $100 bill. They pay the cost of printing, which is usually around 3 to 10 cents per note, depending on the denomination. Even that cost isn't always passed directly to the bank. The Fed covers printing through its operating budget. So from the bank's perspective, it's just an exchange of digital money for paper. They're swapping reserves for cash. And the value of those reserves, well, it's all tied to the trust we place in the U.S. financial system. All right, so how do banks even get those reserves in the first place? That's where the Fed's most powerful tool comes in: open market operations, or OMOs. Here's how it works in simple terms. When the Fed wants to stimulate the economy, it buys U.S. Treasury securities, like bonds, from banks or investment firms. In exchange, it credits the bank's reserve account with newly created digital dollars. And just like that, more reserves in the system. This increases liquidity, lowers interest rates, and encourages banks to lend more money. It's like the Fed pouring water into the financial system to keep things moving. And when inflation is too high, the Fed does the opposite. It sells bonds, banks pay for them using reserves, and that money is pulled out of the system. This back and forth is how the Fed manipulates the money supply without ever touching physical cash. So why does this matter? Because when you understand how money is created, moved, and managed, you start to see the risks backed into the system. Reserves are created by keystroke, cash is printed on demand, and the entire system runs on trust and policy, not stability. If you're relying only on fiat currency, money that can be inflated or devalued by design, you're vulnerable. This affects your savings, your purchasing power, and your financial future. And most people never realize it until it's too late. But now you know, and that means you can make different choices. This is exactly why we talk about gold. Gold is not digital. Gold is not printable. Gold doesn't rely on interest rate decisions or central bank policy. It is real, physical, historically reliable wealth. It has outlasted every fiat system in history, and it's held value through wars, crises, and collapses. When the banking system starts to wobble, gold stands firm. That's why people across the world and across generations have used gold as the cornerstone of real wealth protection. So the next time you hold a $20 bill, remember that little green slip of paper passed through digital reserves, Federal Reserve policy, and a banking system that's far more complex than it looks. Most people don't usually think about that, but now you can. And with that understanding comes power, the power to protect your purchasing power, build real wealth, and break from the illusion of stability. If this video helped you see things more clearly, hit that like button, tap subscribe, click the bell to turn on those notifications, and share this video with someone who also might need help understanding the truth about how money really works. And if you're ready to take action to build a personalized strategy that uses real assets like gold and silver to secure your future, reach out to us at Zang Enterprises. We'll connect you with a strategy specialist who can walk you through every step. This is what we do, and we'd be honored to help you do it too. Until next time, stay safe and stay smart.